All right. Again, good morning, everyone. We'll just get started now. Thanks a lot again for taking some time off on this Sunday. A beautiful afternoon here in Noida. I know you all are joining in from different parts of the world. So, good morning, a very good morning, good afternoon, and good evening to you. Uh, we'll just get started. Before jumping into the presentation, maybe I'll just quickly introduce myself. This is Ankit Parikh. I'm an investment banker by background. I have over 15 years of experience in investment banking, including most recently with Jefferies International, where I was senior vice president covering healthcare sector and was based in our London office. I stayed there for over a decade actually. Just recently moved back to India about a month and a half ago. Before Jeffries, I've also spent few years at UBS and Goldman Sachs. So that was a great experience. And then finally, a lot of people, including my wife, my parents, keep asking me why coming back to India. And I think there are a number of factors here which for which I'm actually very excited and passionate about. And that's how, Invest Advise India development story, opportunity story. I think those are a number of factors which drove me here. In terms of today's presentation, today's webinar, primarily I would be using English as my language. But if any of you would like me to, cover at least some parts in Hindi as well, feel free to let me know. I can speak slightly Bengali, but that's about it, right? My That's my diversification in terms of language. Uh, I know a number of you are may not be able to, given the webinar format, may not be able to speak live, but feel free to share your questions. Send us your questions via Q&A, and I would try to do my level best to address as many questions as I can over the course of the this webinar. In terms of timing, we have budgeted about an hour for this webinar, where I was hoping to cover most part of this presentation over 35-40 minutes, and then hopefully we could have a very live and interactive uh, Q&A sessions where I could answer your questions. I do have a very, very important disclaimer that look, wealth management, when we talk about wealth management, that's a very, very personal thing. That's a very, very customized thing. So here we would be discussing a lot of broad stroke of a number of things, but the what's the right solution for you? That would be that's the answer, which cannot be a generic answer for everyone, right? So that's a important disclaimer I would make. For agenda for today's presentation, I would be spending some time initially giving you a quick introduction of Invest Advice, our capabilities, and then we move on. I would try to provide some perspective on market, long-term trends, and a number of things we could consider while making investments. We do work hard. We all have a day job. To earn money, but then how we can get our money to make work for us and make more money, right? So that's the key. That also those some of those topics also we would be discussing on today's webinar. Maybe just to start with why Invest Advice, or just not even why Invest Advice, but just about us. And I know most of you know us very well. With some of you, we have been working for a number of years, and that we take a lot of pride in. Um, and there are, you must have experienced some of these things. These are not just some of the bullet points which we have put on the slide, but this is actually our philosophy. We believe in everything what we have written here. There's a lot of text on the slide. I wouldn't go into detail, but some of the things I would definitely would like to cover is, for us, client would always come first. I know everyone write this, but this point particularly is very, very close to our heart. Uh, Transparency is another point which is important, along with building the trust. No one can build trust overnight, and we strive to build that trust with you. We strive to be your trusted partner over a very, very long period of time. So our partnership cannot be a transaction driven partnership. It need to be long term, goals oriented, long term, relationship oriented partnership. And based on our experience, we have a number of partners here at Invest Advice who all come from a diverse background, and which we think could be particularly very helpful when it comes to servicing our clients. So moving on, in terms of some of the services, some of our capabilities, what we offer, wealth management planning, as I said. So name is Invest Advice Wealth Management, and as I said at the beginning, wealth management planning, that takes efforts, that takes no one can plan something for someone else without knowing the other person very well, without understanding the risk profile of the individual we are talking about, without properly understanding the goals of the individuals, clients, or corporates we are talking about. So our first aspect is to understand the needs, understand the goals, understand our clients, and then we offer different solutions. As most of you know, we do have a very, very strong real estate practice. We do cater a lot of insurance needs, very active in the market. We have about a 2,000 crore asset under management in a mutual fund practice as well, and tax planning. So I won't go into all these services. I know you guys are aware of most of these, but that's some of the offerings. Now moving on, in terms of our footprint, so we have a global footprint. Most of our clients are from outside India. NRIs actually constitute almost 85% of our business. UK and Europe, about 15%. Roughly, Middle East is a big market for us, and then Southeast Asia and Australasia are some of the other markets which we work on. I'll just take a quick pause, keep taking quick pauses here, and keep requesting you. Happy to make the session very interactive. If you want me to slow down slightly, please let me know. If you have any particular questions on the presentation, some questions I would be very happy to address during the course of this webinar. Some questions we could discuss towards the end of the webinar. Now let's move on in terms of when we talk about when we talk about planning, right? How do you plan, and for what aspects? Sometime a lot of people say real estate is a great investment. I've heard a lot of people come and tell me fixed deposits are a great piece of investments, or commodities are great investments, futures and options, derivatives are great options in terms of the returns they offer. But ultimately, I think the bottom line is what actually you want to achieve. What is your target? And that's how we need to think about planning perspective. Uh, if we move on in terms of, I think the 2020 has been a very, very different year for all of us. It has taught us a number of different things, right? Forget about us, even our past generations, no one has seen this kind of a year where entire world was almost came to a standstill. Flights were not operating. I remember I used to travel like 3 4 days a week, and then suddenly for 9 10 months I was working from home. We all learned how to be more and more efficient while working remotely. I think the barrier between geographies have come down as well. I know at my office, I was, although in London, but I did had a number of teammates. They all went to their hometowns. A couple of guys were in Spain, in Greece, in Belgium, Germany. A couple of guys actually came back to India as well, and were able to spend a good amount of time with their family, along with working very, very efficiently. So that was a great piece of learning. all those were said and done, great things, but the another, which was a trouble part, was there were definitely a lot of job losses were experienced as well, right? And I think my team would fix it shortly. There is some technical error, but you would be shortly seeing the presentation. But the loss of income, loss of jobs, I think that was another slightly painful part of this pandemic. Companies, global governments continue to support their their countrymates in Western world, especially, and not only Western world, but they are cash rich. So there's lot of liquidity being pumped into system, which is trying to at least temporarily helping out industries, businesses, and promote number of businesses, so they can minimize the impact of job losses. But that is one, definitely, I think, sort of unavoidable kind of feature, and we may continue to see a lot of pains about this pandemic even in the years to come. Another very important aspect of this pandemic was the trend of interest rates, and there you would see, to promote investments, most of the governments have keep on reducing interest rates. I think that is great. If you are a home, if you're a borrower, if you have a big mortgage. I remember I have a mortgage. I met number of you one-to-one sessions as well. My mortgage rate is 1.19%, right? And that is just amazing. That was possible because of the interest rate curve, rate cuts in UK now. The bank lending rate is 0.1%. Most part of Europe it is actually 0%. In US it is close to 0%. Japan, same territory. So most of the Western world, um, most of the developed countries are actually trading, are offering around a 0% kind of bank rates. That means for your returns, on a very very fixed basis, there is basically nothing to offer in those countries. And then India is slowly, and we would be talking more about interest rate kind of things, but moving towards, at least if you look at slightly more on a longer term picture, in that direction. But we'll touch base on those topics in the presentation. But before moving in, I think and some of these are very very easy, very very obvious to most of you, but I think sometimes things are very obvious, but the question is, are we taking it that seriously or not? Or after understanding the importance of number of these factors, have we actually implemented these factors in terms of when it comes to wealth management, wealth planning? Some of these are diversification products. We all know that we could go and buy real estate plots, lands. We could go and invest in stocks, either directly or through mutual funds. We could invest in some guaranteed products. We could invest in our pension. We could invest in commodities. We could invest in futures options, so derivative products as well. And all of these products, and there are a number of others obviously, but all of these products have their own features, have their own risk reward profile, which is point number two and point number three. So we cannot just look at one aspect, which is returns, without equally weighing these products against the associated risk. So I think all in all, we should try to look at the our portfolio, and try to diversify it across products based on your own risk profile, and that's very important. If you are a risk averse, I would say your portfolio should be more towards a slightly conservative products. If you are more a risk taker kind of profile, and not only profile, not only your mentality, your age as well. Your age plays a big role as you keep on growing old, as we all are growing old. I think our risk profile, we do turn slightly moderate, and which makes sense, right? You do not want uh, to get some additional percentage points. You do not want to risk it all. So that's another aspect. Now this was product diversification, and then tenure diversification as well. I think our product portfolio, our wealth portfolio need to be diversified from tenure. There would be some products like cash, like mutual funds, which are very very liquid, like your stocks. You could liquidate in day one if you want to. But then there are some products which are very short term, 6 to I would put them this bucket between 6 to 2 3 years category, and up to 3 years I call it a short term investment. So that's one product. Then you need to have a midterm product alignment in terms of about 3 to 6 7 years kind of range. And then you also need to think about slightly long term, 7 8 years to maybe 15 20 25 30 years, because ultimately it's all small savings today that generate those kind of things. So from a both from a product as well as a tenure perspective, your portfolio need to be adequately diversified. And then easy to understand, like this is again very critical. I have actually personally traded a lot of futures, options, derivatives, but I know I know those products are not for everyone. I know how risky it could be. Some of these structured products, right, those are very very complex products. So maybe they suit one individual who has a good financial acumen, but they may not suit everyone. So I definitely one piece of advice which we all know, but definitely sometimes uh, we don't implement that advice, is always try to invest in something which you definitely understand, which is not very very complicated, which is very easy for you. So moving on, I think here I would just cover continuing on our need based solutions approach, that there are number of needs, right? First is family protection, guaranteed returns, how much, if I'm putting something, whether I'm getting my worth back or not, whether this investment would generate a regular income. These are some of the aspects for when you think about what's your goal based solutions, and what are different, if we move on, then what are different life steps for where life stages for which you need to plan. Education, very very important. How expensive, I remember when I was in school, even for best of the school, I think the percentage of I would say my father's monthly income spent on school was not that high. But today, coming back to India, I was in UK, where at least the public education is free, and that's very good as well. But and private education, their private schools are super super expensive. I think they charge like 20 30,000 pounds a year. uh, but same kind of trend we are seeing in same kind of trend we are seeing in India as well, where people pay fortunes for schooling. So and now you need to think about, if you're thinking about your child's education, then and I don't know, like if it is 5 years, 10 years, 15 years from now, and if you take into account inflation, how much that education would cost. Sometime earlier we used to plan only for higher education, but I think now there is adequate planning needed for even a regular school education as well. Lifestyle choices, career paths, family dynamics, retirement. You need to purchase a house. You need to plan your legacy. Retirements. All these are various steps in our life for which we need some planning. And these are like, early to mid career. You have different goals as you approach late career. You have different goals. Now you need to start thinking about your maybe aging parents, your kids, your own retirement. Earlier you were just thinking about, oh, I would like to get a job, I would like to get these things done, buy a home. Buying a home several years ago, until a couple of decades ago, it was about close to retirement. People used to think about buying a home, but now the number of sub 30s are buying home. It's crazy. Even millennials have started buying home, which is a, I would say, unique aspect of how things have been maturing. So there are, I think, that's very, very important. I do not want to rush it. It's a very, very standard slide, but if you double click on each one of those, and if you start thinking about very, very closely, very, very deeply about number of these goals, then you would realize like planning of those, all of those kind of things is that requires some work, right? In summary, that planning does require some work. You cannot just wait on and think like when the time would come, it would be there. You are lucky, and most likely things would fall into place. But it does help to think about some of those aspects in advance. So moving on, I think I would like to introduce you to our, coming back to the point which I had mentioned at the beginning of presentation, that it need to be very, very customized solutions, right? So we have actually developed a wealth management platform where we try to, first aspect is obviously discover is actually learning process. And I think out of all the process, this is actually the most important process, where we try to learn about our clients, about the risk profile of our client, about their family, about their children, about their parents, about their own financial situations. And then we try to put those, all those things together on our previous slide, which is like all those different goals, and and we try to understand like what are your goals, right? So and then accordingly we would because we are, I think one thing I take pride in, I'm not associated to anything particular product, any particular company, or anything a very, very product, very, very specific provider. For me, you are my clients, right? So for me, I'm neutral, right? If for you some particular product, one particular product suits, nothing stopping me, right? So I would just go, I would have a very, very independent view based on the situation, on what actually suits you. And that's how all our different partners at Invest Advice, that's our approach is. And then accordingly we would advise you, and we would try to implement you, um, and start working towards those goals. And I'm telling you, I have not met even a single person for whom, after first meeting or even after some amount of investment, they have been able to meet goals, right? So it's all about the start. If I show you the number, you would be seriously surprised. I was surprised when I put my own planning into that system. It throws big numbers, because in reality, and I'll give you one example. If today I'm spending, let's say, about 3 lakh a month as my living expenses, and I plan to retire in about 15-20 years. If I take inflation into account, to maintain similar kind of lifestyle, I need about 6, 7, 8 lakhs rupees a month, right? Or because lifestyle could slightly improve as well, or maybe at least 5, 6 lakhs a month. And generating that kind of wealth when I'm not working or plan not to work is not easy, right? It takes would take a lot of effort. So that's how we always say, like, start small, but do start. Don't wait for uh, don't wait for something, and that things would happen. So I did had Pushkarji, I would come on this interest rate profile on India. That's a very, very good question. I do plan to cover that topic. So let me go through. But I that's in my agenda to cover that topic. Uh, so moving on, I think, and I think we are almost there. So this is that's a perfect timing, Pushkar, as you asked. So look at, so I've just put together a simple, very, very simple slide of bank rates in India. This is an example in India, where and I have tried to show you a slightly longer term uh, view, where for last 2 decades, if you take a look, interest rates were hovering around 11-12%. Actually, even if you go slightly more, around 95, 98, and a lot of you would remember interest rates were as high as 14, 15%. And this I'm talking about is the bank rate, right? So bank rate means even your fixed deposit rate. Today the bank rate is 4%, so your fixed deposit rate is somewhere around 4.9 5%. So when your bank rates is about 12% or so, you could imagine your fixed deposits would be yielding you about 13, 14%. Your home loans would cost you about 16% or so. Today home loans cost as low as 6.5, 6.75%, which is crazy. And I think now the question would be, what would be the forecast? And I do feel very, very strongly about it, that the forecast is the curve would be downward sloping. There may be some ups and downs, as we have seen in the excuse me, as we have seen in the past, but on a long term basis, the interest rate curve would be a downward sloping curve. If we talk about a lot of projections are actually, I was reading about number of projections which predict interest rate would be around 3.5%. But all in all, I think over 15, 20 years period, interest rate would be moving more towards developing nations. India is if you take out the pandemic year as a one off, then India is moving slowly towards that developed country, developed nations, at least directionally towards in that direction. And if you look at interest rate of any developed market today, not only in pandemic, even pre-COVID era, those were very, very low. So we would be, over a long time, we would be hovering towards directionally towards that 1-2 percentage zone when we talk about a very long period. Like, equally, if I extrapolate this for another 20 years, I do think interest rate would be somewhere around 1.5-2% zone, even in India. Moving on, some of the aspects are in terms of and this is another some of these numbers are actually not updated. If you look at and purposely we have not updated because then you're slightly biased towards COVID era. But even if you try to look at slightly more normalized returns, then for most of the countries, it is a sub 1.5%. So that's the returns, and that's why I particularly like the opportunity in India, where the overall size of economy, and overall the growth of economy relative to the size is still very, very appealing, right? There are still number of products, fixed deposit rates still offering. A lot of people say it's very, very bad. I agree, it's not attractive, but if you think about it, it is still much better than what most of the other countries are offering. I do understand there is implication of inflation into the returns as well, which makes it the net return slightly less attractive. But I think if you have a very, very macro view, very, very broad long term view, then India still offers, even on balance a risk reward basis, number of attractive options. And then NRIs, I think that was an important point for me, because the taxation for NRIs, India's taxation treaties with most countries, so you do avoid double taxation, I think, which is for you, it is there is some element of forex movement, but still it does provide some attractive options. Now, if we move on, this is another topic I wanted to cover on today. So we talk about the movement of interest rate, and I wanted to show equally last 10 years picture of how the this is a BSE Sensex. I've just taken a representative market returns example here. And if you take a look, like on a CAGR basis, annualized basis, last 10 years markets have given a return of roughly about sub 10% return. Overall, markets are up about 150%, and that's a very good return. If you ask me honestly, Why today market is actually breached 50,000, I don't know, right? Everything good in India that markets are skyrocketing? I don't know, and I do not think so. Right. So that's my very, very strong view right now. Right now, I think the rally is driven through, very much driven through the liquidity injection by most of the governments. They are pumping in liquidity that is driving stock markets. Fundamentals are moving in that direction, but not quite there. But that's not the point. Point is, over a 10-year period, the markets have given you attractive return if you had patience, if you have slowly. Say for example, someone who has started investing into SIPs, right? And maybe started with as little as like 5, 10,000, 20,000 a month, which is holistically not a big money. But over the period, that guy today would be sitting in a big chunk of money. I think that's the point, that you need to have a slightly long term view, and then you would hopefully do reasonably well. And I think we could project this thing for a slightly longer term as well, in terms of uh, over a long term. I do think the equity markets would give you on a pre-tax basis about 9-10% kind of return. uh, Moving on, I think this was more of what's happening, more of a market perspective, from equity perspective, individual story, interest rate outlook. And now I would try to provide you some illustration, walking you through some illustration when we think about uh, when we think about equity. One thing is, like, it's actually could be quite great investment, but it's risky. But then there are a number of products, and given the limited time, we could not discuss about a lot of things. So I've just taken a couple of illustrations here, and everything is flexible, variable here, which I would walk you through. There are investment plans available which offer you a lump sum money. When I say lump sum money, again, you need to relate that to our previous slides, where we talk about goal based solutions. So question is, what are you planning for? Are you planning for retirement? Are you planning for a child's education? Are you planning for a child's marriage, or higher education, those kind of things? Then accordingly, you need to have a trigger year, and then we need to work backwards. How many years I have left to achieve that goal? Answer: ideally, it need to be preparation need to start a long time back. So answer could be 10 years, 12 years, 15 years, 18 years, 20 years, 30 years, whatever, right? The longer the period, the better the options would be, the minimal the investment required would be. But here, and then you try to match your goals with the investment today. In this illustration, just to give you a very, very quick illustration, we have assumed for about 40,000 monthly investment, about 5 lakh annual investment over a period of 10 years. So if you start investing over a period of 10 years, all in all, you have invested about 50 lakh. Um, this product is like over it's a 15-year duration product. So at 15th year, you would get 87, almost 88 lakhs, right? If you work the calculation, this is giving you a guaranteed return of 6%. It's a fully tax-free return. So now go back to previous slide, where we just saw equity market, and everyone say equity market, high return kind of market. It very well could be, but not everyone could time the market well, right? So assuming you are those that a passive investor who have stayed invested in mutual fund, which is tracking the broader market, and you got roughly about 9-10% return. That's a taxable return. So on a tax adjusted basis, if you take that into account, roughly we are talking about a 6.5 to 7% return. That's very important. That's eye opener for many. even in equity markets over a long term, you get a return of on a tax free, tax adjusted basis, post tax basis, you get a return of anywhere between 6 to 7%. If there are products which could offer you a tax free return, post tax returns of 6% on a guaranteed basis, then I think that does solve the purpose. Don't take me wrong, I'm not telling anyone to not invest in mutual funds, not invest in equity. I think equities and mutual funds need to be there in your portfolio. But then you need to, from a risk reward perspective, try to balance it out with some of these kind of products as well, where you have a very very clear visibility in whether the policy term need to be 10 years, 12 years, 15 years, 18 years, 20 years, or whatever. That depends on the goals for individual. uh, there's another example, another illustration I have put here, which is more on a regular income mode as well. Because when we think about retirement, I think the perfect retirement is when I retire, I do get a slightly kind of lump sum, some amount. In a number of private companies, the pension plans are still there, but that could vary for individual to individual. So ideally, if there is there is a pot of lump sum money I could get at retirement, and then I could secure a regular income on a monthly basis. I think that's key, right? So that's very very important. And I was actually amazed to see how there are products which are as long as 36 years. Now 36 years sound too long a year, but if after investing for, let's say, 5 year, this is a same premium paying term for 10 years, but you could do 5 years, 7 years, 8 years, 10 years, and even longer. uh, but after investing anywhere from 5 to 10 years, if I can secure my entire life, entire retirement, I think that could be a very very good strategy for number of individuals in that age bracket, if they want to have a very very tension free, a regular income flow, right? Because at that point in time income would disappear, but if some amount keep hitting your bank account, I think that could be a great way. This in this example, obviously getting about you are putting in 5 lakh per year for 10 years, you are getting almost about same amount for next 25 years. And then you're getting your initial investment back as well. So all in all, you're paying 50 lakh, you're getting back almost like 1.7 crores on a fully tax free basis. That could be a very good solution for a number of guys. But bottom line is why I took 5 lakh, right? Ultimately for 4.73 lakh, so even 5 lakh on an annual basis would not solve your purpose. Getting 50,000 or 40,000 uh, 10 12 years from now would not be a big money at all. But you need to start somewhere, right? You need to start somewhere, start with small, but gradually you try to keep increasing as you have visibility, and then try to keep increasing your pot of monthly income post retirement. I think that is the key. That's why I came back, like you would not solve, even if you want, for most of the, for 95% of population, it's just not possible to solve for their goals in one go. It's a gradual process, it's a recurring process, and that's what we need to work towards. So that was brief about today's presentation. I didn't want it to include a lot of varied products. I think we would try to do these webinars on a very very regular basis. um, but the purpose would be to at least try to cover one or two products in each of these webinars. I would just take a pause here. I've received some questions, so maybe I would try to spend some time there. Pushkarji, you asked about future rates, interest rate profile. I did try to address that question, and I think I do see on a long term basis it would be a downward sloping uh, uh, interest rate curve would be a downward sloping. I think then I don't see a name here, but some of our friends have asked about property real estate projects, I'll get my team to reach out to you in terms of omics and some other real estate investment opportunities. someone would reach out to you and would explain the product there, if that's okay. I think Pushkarji, you also asked about target return schemes above and over prevailing banking rates on inflation-adjusted basis. I think now this is a great question, right? So we need to think about how our returns adjusted for inflations. What does that actually mean? And I think if you different parts of the world, it is actually net neutral, right? A lot of countries are offering zero returns on your savings, but inflation, they are witnessing about anywhere between 2-3% inflation. I'm talking about more developed markets. So that's a net negative real return. In couple of illustrations which I mentioned, assuming a long-term inflation in India of anywhere between 3-4%, and again we are talking about slightly long-term profile. The returns are net returns adjusting for inflation, and also for the taxes would be somewhere around 3%, which this number again may look smaller, but if you need to compare it against what we all consider risky investment, like stock market. Even on a long term basis, stock markets have given 9.5, so which translate to about 6.5-7% on a post tax like by like basis kind of return. And here you have something which is absolutely guaranteed tax free. You have exact visibility of dollar amount or rupee amount or whatever, and you could get this. Yeah, so I think that's what we need to weigh, that at least some portion of wealth need to be in these kind of things. Some portion of wealth definitely need to be in stock market, mutual funds, and then another instrument like commodities, like real estate, would definitely be part of your overall profile. uh, I hope I answered that question. Moving on from Salmanji, is it possible to provide more details of the boss? Absolutely, Salmanji. We would be again happy to would have discussion with you and provide a lot more details with you on those aspects. Dilip ji has actually very good question in terms of investment in debt funds. Absolutely, debt funds are different debt funds as well, and we would be very happy to provide some recommendations to you. I do plan to cover a session specifically targeting on mutual funds, where not only when I say mutual funds, not only equity mutual funds I talk about, but I do like a lot of debt funds, and then again basing. I do these kind of things. I don't want to make a generalist statement like, oh yes, 50% need to be debt funds, but depending on your risk profile, uh, uh, one portion definitely need to be in debt funds. If you're more conservative, then I would call it more slightly, or of a mutual fund portfolio, more than 50% need to be in debt funds. But otherwise, they are they are taxable. So the return, from a returns perspective, you need to pay taxes, and then most of the debt funds I think pay in category of 6 to 10%. Like 10% debt is actually very sometimes risky debt. So debt funds do offer somewhere around a 7-8% on a pre-tax basis. Then taking taxes into account, we are talking about roughly 5-6% kind of return. And then Subu, your question is start exchange traded funds. And now by starting, I mean you mean from an investment perspective, start investing into exchange traded funds. Absolutely right. So that's a lot of there are a lot of listed funds, and who are doing well as well. And if you have a, again, these are more like, I would say, more like stocks, where if you could time the entry exit, I think that could be because of the traded nature, you get a good liquidity. But in mutual funds anyways, you could redeem a portion of mutual funds anytime, but ultimately a lot of traded funds are doing very well. So that could be a very good strategy as well. uh, Now, in terms of like some other questions which we have received, a lot of people would like to understand in terms of when they think about retirement, whether long term return is better or lump sum is better. That's a question we all need to ask for ourselves, and we need to, I think a combination of both need to be there. um, it need to have a very visible long term profile, but whether one is good or other, I think that's a bit complicated question for me to answer on this webinar, given all your goals or strategies would be very different. But I think if I need to be very generalist, I would say think about a combination, but now what type of combination and what the quantum of that combination is, I think that need to be a very more individualist personal discussion. There's another question on tax free, whether there is any tax benefit. Absolutely. In India, if you invest, and most of the NRIs, I used to file returns in India, and there are eight under section 80C, there is some portion that helps you on the taxes. All the returns which we discussed in those couple of illustrations particularly, all those returns are fully tax free returns, and including the lump sum that is tax free as well. Okay, so I think if anyone else has any other question, I would be very happy to answer them. I know it is Sunday. Again, I really appreciate you guys taking some time off. I would love to have individual discussions with you guys, but or how are risk related to impact of in long term, and especially on returns. Yep. That's Pushkarji. That's a great question in terms of regulatory changes, right? So now the investments, the illustrations which I covered, those are already under those are already regulated by IRDA, and uh, they need to the rule is when they are using when the companies, and by companies I'm talking about companies like ICICI, HDFC, large financial institution, Max, all these guys, when they are offering a guaranteed product to their customers, as per IRDA norms, they need to invest in particular kind of securities. They cannot go about and invest in short mutual funds or small mid cap. So their most of the investment would need to be in government treasury, very long term. So the reason the longest product we have is about 30-35 years, because the longest duration of government bonds is about 30 years. So most of the funds are actually invested in those kind of thing, and then it's actually more kind of escrowed. So for a particular fund, the funds are already invested, and from returns thereof, the investors are paid off returns. So that's how the risk reward and future safety is taken care by the regulators in our case. And ultimately, I think because risk is a very important term, right, when we think about investment. And in our case, what happens is, are we investing into something which there is a good chance of going belly up, or less chance, I think, ultimately, right? And most of you would remember, not long time ago, like it was about 10 years ago, when we had a subprime crisis. I, being an investment banker, I can never forget that time. Lehman Brothers went belly up, and there were a number of other large corporations went belly up. Lehman Brothers were offering their services to very specific, and not to individuals. Lehman Brothers was not individual; it was like investment banking advisory to some corporates. Although they did had investment in number of other things, but no direct retail investment. But when we talk about organizations like State Bank of India, like ICICI, HDFC, Max, all these guys are managing. Over a lakh crore, 80,000 crore, 70,000 crores of assets under management, and most of their investments, most of their investment is actually from retail investor class. So a government cannot let these institutions, even in a burst of time, to go belly up, because that would just disrupt entire market altogether, and that would be very, very risky from an individual retail investor perspective. Yes Bank, although it was one of the very small bank, but there is a reason why the government, why large banks came to rescue, and not even a single penny of investors were lost. Retail investors were lost, because you can't banks the governments can't let large financial institutions which are so engraved into retail base to go belly up. So along with the current regulations, those kind of things we need to keep in mind as well. Finally, these products are evolving products. Same product we're offering until 2 3 years ago, offering a guaranteed return of about 7.5%. Today they are offering about 6%. I know within 2 years they would be offering. ICICI has already recently, just 2 weeks ago, have cut down the guaranteed rate by 0.5%, right? So they would be offering 5%. So they move on along with the interest rate. And I can tell you that these products would be, in 3 years, 5 years, they would be offering about 4 5%, and they would be equally attractive even at that point in time, because if you compare them against the prevailing interest rate, they would still do far better. Plus you would have that kind of visibility for a long term. If you try to invest something in products like this for a long term, between 7 to 8 years, you would be sitting, you have already logged yourself with something which is offering almost double or close to double of prevailing interest rate. Think about it, right? Then it would be considered I would say slam dunk kind of investment, that you did a great job of locking that thing down. So those kind of things need to be kept in mind. Okay, I think I have tried to address. There are a few questions on other uh, how to reach us, and I think team would assist you. You do have some contact details here, feel free to reach out, and then we could have a more thorough discussion with you all. But yeah, it does seem like a very, very attractive product for I would retire. Yeah, no, no, it is, it is. I think could be a very good product for a number of different individuals. We are keep getting some questions on uh, through YouTube channel and through emails as well. All right, I think Ashish, I have answered most of the questions. I'm not sure if I'm seeing all the question at one place. You keep throwing different questions, so if there are any other questions from any other platform, let me know. Otherwise, I really thank you everyone for joining today. We had hopefully it was productive. Hopefully it was slightly useful when it comes to thinking about how the markets are performing, and how you should be thinking about your investments. If there are ways we could be helpful, we would love to help you out. But otherwise, hopefully in next couple of weeks we see you again with another exciting topic. Thank you.